The tech world thrives on innovation, propelled by capital and specialized banks. In 2023, Silicon Valley Bank, a vital financial pillar for startups, abruptly fell, causing global shockwaves. But what if that critical moment never arrived? What if the very core of tech finance simply didn't collapse? And let's find the answer to the question, what if? Without the dramatic collapse of Silicon Valley Bank in 2023, the tech ecosystem breathes a collective sigh of relief, entirely averting a potential panic. Startups never experience the paralyzing fear over payroll access, frozen cash, or the sudden instability of their primary financial partner. The stressful, widespread scramble for emergency alternative banking solutions or crucial bridging loans simply never materializes. Consequently, venture capital firms operate business as usual, free from the immense pressure to audit portfolio companies' cash positions or issue urgent directives about diversifying bank accounts. Investment activity proceeds smoothly, entirely unimpeded by market uncertainty. SVB, in this timeline, continues its deep-rooted specialized relationship with its tech and startup clients, fostering an environment where innovation maintains its rapid trajectory without any significant financial tremor disrupting its path. In an alternate reality where SVB remained stable, regional banks would have navigated a much calmer economic sea. The widespread contagion fears that triggered deposit outflows from other mid-sized institutions simply wouldn't occur, sparing the sector from a wave of instability. This stability means less intense scrutiny on regional banks' balance sheets, particularly their bond portfolios and interest rate sensitivities, as the catalyst for such concerns never materializes. A more predictable operating landscape emerges. Moreover, the intense public debate over deposit insurance limits, the scope of too big to fail, or government guarantees for non-GSIB banks would be significantly muted or absent, thus preserving public trust in existing financial frameworks. In this calmer timeline, the Federal Reserve's crucial fight against inflation proceeds smoothly. Without SVB's collapse, their interest rate decisions remain solely focused on key economic data like inflation and employment, unburdened by concerns of banking instability. Policymakers aren't pulled into urgent crisis management, allowing them to maintain planned agendas. There are no immediate urgent calls for sweeping regulatory overhauls or intense investigations into bank supervision practices. Instead, regulators continue their work, refining existing frameworks and dedicating resources to long-term economic stability. This steady, undistracted hand fosters greater predictability and reinforces public trust in the financial system's oversight, rather than eroding it with unexpected failures and reactive measures. In this alternate reality, Silicon Valley Bank demonstrates remarkable foresight, tackling its inherent interest rate risk not through a crisis, but through strategic, proactive measures. Rather than waiting for market panic, SVB engages in gradual, opportunistic bond sales, enhances its hedging strategies, and executes a controlled capital raise. These actions are all undertaken before any hint of a bank run, illustrating a sophisticated approach to financial management. Consequently, SVB transforms from a potential cautionary tale into a shining example of proactive risk management and adaptive financial strategy. Its leadership remains laser-focused on refining its unique business model, perfectly tailored for its specialized client base. This successful navigation of financial challenges solidifies SVB's reputation as a leading and reliable financial partner for innovative companies. By retaining its extensive network and deep understanding of the tech industry's distinct needs, the bank even strengthens its position, becoming an even more trusted pillar of the innovation economy. The absence of SVB's collapse means the broader economy avoids a profound jolt of uncertainty. Consumer and business confidence remains significantly more stable throughout 2023, as the widespread shockwaves of a major bank failure, which would have fractured public perception, simply do not occur. Investment sentiment, especially in dynamic growth sectors like technology, is thereby spared a sudden, sharp contraction or increased risk aversion. Instead, capital flows continue their trajectory more smoothly, primarily influenced by overarching macroeconomic factors rather than systemic fear. Consequently, the overall narrative of the 2023 economy is shaped far less by concerns of financial instability. It remains focused on ongoing battles against inflation, labor market dynamics, and global geopolitical events, effectively preventing a potent financial fear component from influencing crucial economic decisions and fostering a generally steadier path forward. SVB's averted collapse would mean stable tech, regional banks, and economy. In your opinion, what if Silicon Valley Bank never collapsed in 2023? Share your thoughts in the comments.